Hi, welcome back. Our previous lesson was on the supply and demand of labor. Today we'll be focusing on labor demand, which is how employers decide how many people to hire. So, one very important question that an employer has to answer is how many workers should a firm hire and at what price? So we know the demand for labor, that it represents the quantity of labor that an employer will hire or is willing to hire at different wage rates. Now, the optimal number of workers to hire and the corresponding wage rate depends on various factors, and the decision is influenced by the principles of supply and demand in the labor market. Now, let's look at some key things that employers consider in making this decision. Now, the first thing is that in a competitive market, employers pay what we call the market wage. So, we remember from our previous lesson that we had the labor demand curve and then the labor supply curve. And we said that this is the point of equilibrium when the two curves intersect, creating an equilibrium wage. Now, some people call this equilibrium wage, market wage, competitive wage, prevailing wage. We'll be using these terms interchangeably. Now, what we are saying here is that perfect competition is where there are loads of firms looking to hire from a wide pool of workers with very similar skills. So, as a firm in a perfect competitive market, you'll find that there is usually a prevailing wage rate, which in this case is W star. And it is determined by the forces of demand and supply that you need to pay to hire workers. Now, if you decide to pay below this wage rate, no one will work for you because everybody will go and work for your competitor because they are paying this prevailing wage rate in the competitive market. So if you want to go below this to pay W prime, you lose all your workers because they'll go and work for your competitors. Now, no firm will also want to pay above this wage rate because it's not optimal. So, mostly firms in the competitive market will arrive at paying W star. And this is because they are hiring people with similar skills, and then they also have a lot of competitors. So they can't afford to pay below what the market has determined. Otherwise, no one will work for them. Now, the next thing that the firms will also take into account when making their labor demand decision is that in the competitive market, the real choice that they have is deciding how many workers to hire. So, this is because, as we have said initially, the wage is determined by the market. So, in a perfect competitive market, firms do not have the option of determining or adjusting the wage. Now, their only choice that's left in optimizing their profit is to determine the quantity that they're going to hire at that particular wage rate. So, how do they make this decision? In deciding how many workers to hire, a firm will hire one more worker only if that extra worker yields a marginal benefit greater than the marginal cost incurred. So a firm's marginal cost is the cost that you incur from hiring another person or an extra person. So the marginal cost of another worker is the increase in your business cost due to hiring one more worker. And if you look at this critically, you realize that it's simply the wage you pay that worker. So the cost you incur when you hire one more person is just the wage that you're paying that extra person. So we can say that in this example, if we are considering just labor in the market, no other inputs, a firm's marginal cost is just the wage rate. Now, the marginal benefit in this case is the extra benefit you get from hiring a worker. So a firm's marginal benefit is the extra benefit that you get from hiring one more worker. Now, one way to measure this marginal benefit is to look at what we call the marginal product. So you can measure this marginal benefit by looking at the marginal product. So what does marginal product mean? It is the extra output that you produce from hiring one more worker. So this means that if I'm producing 10 units of good and I have one more worker and I pay them a particular wage rate. Now, if this worker brings 2 units, this is the marginal product of the worker. So, from what we're saying here, one a way of looking at this rule is that a firm will hire one more person if the wage that they are paying the person is equal to the benefits that they are getting from hiring that person. And if we are looking at marginal product as one of these benefits, then we can say that a firm will hire somebody if the wage that they are paying the person is equal to the marginal benefit or marginal product that they are getting from that extra person. Now, the marginal product has certain characteristics, and one of these characteristics is that it becomes smaller and smaller at some point as output increases. So, what the marginal product or the additional benefit that the person adds to your output, it increases and increases, gets to a point, and then starts to decline. Now, this is called diminishing marginal returns, and we'll look at this in detail in our future lessons. But then, because of these characteristics, firms will want to measure their marginal benefit in terms of extra money and instead of extra output. So in this case, let's take a restaurant for instance. So a restaurant will want to measure their marginal benefit in terms of extra pound earned from hiring a worker instead of looking at an extra bowl of rice that they produce. So in this case, the restaurant will focus on what we call the marginal revenue product of hiring a worker. Instead of just the marginal product of hiring a worker, they will focus now on the marginal revenue product of hiring a worker. What we call marginal revenue product is simply your marginal product times the price of the good. So this measures the extra revenue produced by hiring an additional worker. So an example of this is that if a restaurant has one more waiter and then the waiter sells 4 more bowls of rice per hour. Now, so we have 4 bowls of rice per hour. Now, if each bowl of rice is £5, so if we have each bowl of rice being £5 per bowl, so then what is the marginal revenue product? So this is simply calculated as the 4 bowls of rice that the extra worker has produced, which is now called the marginal product, times the price of each bowl of rice, which is 5. So then it means that this extra worker is bringing the firm additional revenue of 20 per hour. So as a result, this restaurant will hire an additional worker only if the wage that they will have to pay that worker is less than or equal to £20 per hour. So it simply means that the wage that they will pay you must be equal to or less than the £20 that you are bringing to the company per hour. So if you look at this analysis, you realize that any wage above this £20 per hour is not efficient, because if I'm paying you more than I'm getting from you, then that is not efficient from a firm's point of view. And then any wage below this is also not optimal, because if an extra worker will bring you something bigger than the wage rate, then it will be optimal to hire more and more and more until the additional worker brings you equal to 20. Now we can understand this better using an example. So we have here the number of waiters, and then we have here the marginal product, which is meals sold per week. So when we had one waiter, we had the marginal product of that waiter as 40. Now the second waiter brought 35. When we added an extra one, that extra one brought 30. When we added an extra waiter, they brought 25. When we added an extra one, they brought 20. Now, first, before we calculate what our marginal revenue product, you can see that as we add more and more waiters, the marginal product also declines. So this is what we talked about previously. Now let's find our marginal revenue product, which is the marginal product times the price of the good. So in this example, the price of a good is 20. So we can say the price of a bowl of rice is 20. So for one waiter, the marginal product is 40 and the price is 20. So 40 times 20 is 800. For the second person, the marginal product that they brought was 35. And then the price of the good is 20. So that gives us 700. Then for the third person, the marginal product they brought is 30 and the price of the good is 20. So that gives us 30 times 20, which is 600. Then for the fourth person, the marginal product is 25 and the price of the good is 20. So that brings us to 25 times 20, which is 500. And then similarly for the fifth person, the marginal product they brought is 20, and then the marginal revenue product is going to be 20 times 20, which is 400. Now, if we assume that wage is constant, it doesn't change per worker. This is not usually the case, but to make our example simple, we are going to assume a constant wage. Now, the decision here is that given this wage and given this marginal revenue product, how many workers should the firm hire? So you can see that for one worker, the marginal product that they are getting from this worker is 800, but the wage is 500. So a particular worker brings 800 pounds more to the company, but then that worker is being paid only 500. So the company is getting an excess of 300. So it'll be better to hire some other person because the other person will bring something higher than the wage that you're paying. So the next person that the company hires, which is the second waiter, brings 700 pounds, which is still bigger than the wage. So the company is still making profits. Now the company decides that, okay, if the next person is still going to bring something more than the wage that I'm paying them, then I should have more. So the next person brings 600, and then the wage you're paying them is 500. So they move on to the fourth waiter. Now the fourth waiter brings marginal revenue product of 500, but the wage that they're paying now is 500. So when you look at the difference in these two, you see that is zero. So they are essentially making no profit by hiring the fourth person. Now, if the company were to hire another person, which is the fifth person, then the fifth person brings a marginal revenue product or an additional revenue of 400, but then it costs you 500 to hire that an additional person, which is not efficient because you are paying the person more than they are adding to your profit. So in this example, the restaurant will have 4 waiters because this is the level at which the wage that you are paying the worker is equal to the marginal revenue product of hiring this additional worker. So in this example, the optimal level of waiters or the optimal number of waiters is 4. Now, this is all that we have on the first part of our lesson on labor demand. Our next lesson will be a continuation of this labor demand lesson. If you enjoyed today's lesson, consider subscribing. Thank you.